Welcome to The Explainer. Today, we are cracking open the Investor's Toolkit. We're talking about the key financial ratios that let you see past the marketing hype and understand what a company is really worth. Our mission here is to help you decode all those numbers so you can make smarter, more confident decisions.
You know the feeling. You see a stock that's just shooting for the moon, and you get that classic case of investor FOMO, the fear of missing out. But how do you really know if you're looking at the next big thing or just a bubble that's about to pop? It's the ultimate dilemma for any investor.
Well, to get to the bottom of it, you don't need a crystal ball. Nope, you just need the right set of tools. And today, we're going to show you how to use a few simple financial ratios to look right past all the noise and see what's actually going on inside a company.
So, let's get one thing straight right from the start. A stock's price, all by itself, is pretty much meaningless. Seriously. It doesn't tell you if a company is strong, if it's weak, if it's cheap, or if it's expensive. It is just one tiny piece of a much, much bigger puzzle.
So, let's get to it. We're going to build your essential investor toolkit so you can start looking deeper. The first set of tools we're putting in your belt is all about profitability. You know, these are the tools that help answer the most basic, fundamental question of all. Is this company actually any good at making money? And here's your first tool, return on equity, or just ROE. The easiest way to think about this is like a report card for the company's management team. It tells you exactly how good they are at using the money that shareholders, like you, have invested to generate actual profits.
So what's a good grade on this report card? Well, a good rule of thumb is that an ROE that's consistently over 15%, that's a pretty strong signal of an excellent, really well-run business. It means management is just doing a fantastic job with the capital they've been given. Okay, next up is return on assets, or ROA. Now this one is a little different. While ROE focuses just on the money from investors, ROA looks at the bigger picture. It asks how well the company uses everything it owns. We're talking its factories, its cash, its inventory, the whole shebang, to turn a profit. A high ROA usually points to a lean, efficient, well-oiled machine.
Okay, so a company might be profitable, but here's the real question. Is it a good buy at its current price? To figure that out, we need our second set of tools. These are all about valuation, and they help us figure out if a stock is fairly priced, if it's a bargain, or if it's just way too expensive.
And this brings us to the most famous ratio of them all, the price-to-earnings ratio, or PE. This is your quick gut check on market sentiment. A high PE means investors are willing to pay a hefty premium for every dollar the company earns, usually because they're betting on big growth down the road.
But the PE ratio has a blind spot. It's only a snapshot of right now. And that's where its smarter cousin, the PEG ratio, steps in. The PEG ratio is so powerful because it adds that one crucial missing piece to the puzzle, the company's expected growth rate. This gives you a much, much richer picture of the company's value.
So what's the secret here? Well, a lot of savvy investors look for a PEG ratio that's below 1. Why? Because finding a company with a PEG below 1 can be a huge sign that its stock might actually be undervalued compared to how fast it's expected to grow. It could be one of those hidden gems.
Our last valuation tool is the price-to-book ratio, or P/B. Now, this is a classic favorite of so-called value investors. It's super simple. It just compares the stock's price to the company's net worth if you were to sell everything off. A P/B ratio under 1 might mean you're buying the company for less than its parts or even worth.
All right, so now you've got your profitability tools and your valuation tools. You're feeling pretty good, but just knowing what the tools are isn't enough. The most important lesson, the one thing you have to remember, is knowing how to use them correctly.
And here it is. This is the golden rule of financial analysis. A number, by itself, is completely meaningless. You have to compare it. You have to compare it to the company's own past performance, to its direct competitors, and most importantly, to its entire industry.
Just take a look at this. It says it all. For a tech company, a PE ratio of 25 is totally normal. The market expects crazy growth. But if you saw a bank with a PE of 25, whoa, that's a massive red flag, because their average is usually way down, between 8 and 15. Same thing for ROE. An 18% ROE is incredible for a bank, but it's just kind of average for a big tech firm. So here's the bottom line. Context is absolutely everything. A good number in one industry can be a flat-out bad number in another. You can't compare an energy company to a software company using the same measuring stick. It just doesn't work.
Okay, let's bring this all home. We're going to distill everything into a final, practical checklist. Think of these as some general warning signs to keep an eye out for when you're doing your own research.
So if you see a PE over 30, you've got to ask yourself, does the growth story here really justify that premium price? If the ROE is less than 5%, you should probably question how effective management really is. A PB over 5 could be a sign of overvaluation. And a dividend yield, that's the annual dividend compared to the stock price, over 8%? I mean, that sounds amazing, but you have to wonder, is a payout that high really sustainable long-term?
Now, of course, this is not financial advice. We're giving you the tools, not telling you what to build. But this is an incredibly powerful starting point to help you cut through the hype, start asking the right questions, and begin your own journey as an analyst.
So there you have it, the Investor's Essential Toolkit. You now have the instruments to look beyond a soaring stock price and analyze what's really going on with a company. So the only question left is, what are you going to investigate first?